36%. Those are the odds as of this morning that the Federal Reserve raises rates next month into an economy that just lost 23,000 jobs. One closed strait half a world away is setting the price of your money. Today, 4 crypto stories, 3 macro, 4 AI. And at the end, the 8:30 inflation print that decides everything else on this screen. Crypto is frozen at a line in the sand, and Washington is holding the pen. 1. The SEC says if Congress will not write crypto's rulebook, it will. The Clarity Act is shelved until a September 15th vote, so Chair Paul Atkins said the agency is, quote, ready, willing, and able to come out with rules of its own. The bill passed the House 294 to 134. It needs 60 votes in the Senate. The holdup: Democrats want ethics rules aimed at President Trump, whose family reported over $1.4 billion in crypto income last year. Whoever writes this rulebook decides which tokens live, who custodies them, and who profits. 2. Cold Card, one of the most trusted cold wallets in Bitcoin, had a firmware flaw since 2021. Its random numbers were not random. Attackers brute-forced seed phrases, and at least a dozen of them did it. Victims never touched the internet and got drained anyway. Around $130 million gone. Same week, Bitcoin funds pulled in $850 million, part of over $1 billion into crypto products. A self-custody failure sent Bitcoiners running to BlackRock. The fix for being your own bank was handing the keys back. 3. Bitcoin spent Tuesday stuck under 64,000, slipping to around 63.7. Ether held near 1880. The whole market eased 0.5% to 2.26 trillion. The reason is not on-chain. It is oil and the inflation it feeds. If this morning's print runs hot, rate hike odds jump and crypto takes the first punch. Today, Bitcoin's price is not set on a blockchain. It is set by the Bureau of Labor Statistics. 4. BlackRock just put $311 billion of European money market funds on Ethereum. 6 funds tokenized through JP Morgan's Kinexys platform, round-the-clock transfers, real-time visibility, professional investors only. The most conservative product in finance now settles on a public blockchain. The chains won the argument. But look at who collects the fees: BlackRock and JP Morgan. The rails changed. The landlords did not. Bitcoin at 63.7, dominance around 56, and fear and greed dead neutral at 46. The whole market is holding its breath for 8:30. That is crypto today. Gold says panic. The VIX says nap. This morning, one number settles the argument. 1. At 8:30 this morning, the July inflation print lands. Consensus says around 3.3 to 3.4%, cooling slightly from June's 3.5. Core near 2.4. And markets put roughly 36% odds on something we have not seen in years: a rate hike in September. Days ago, the jobs report showed the economy lost 23,000 jobs. Yet Cleveland Fed President Beth Hammack says multiple hikes may be needed. Raising rates into job losses is the stagflation playbook. Whichever way it breaks, borrowers pay the toll. 2. The Strait of Hormuz carries about 1/5 of the world's oil. It has been effectively closed for almost 6 months. Tanker traffic is down from around 130 transits a day to as few as 8. Brent sits near $84, up around 16% since the war began. President Trump says the U.S. is, quote, only semi-negotiating. Iran wants sanctions relief and war reparations first. 64 violent incidents at sea, 17 sailors dead. Every week that Strait stays shut is a tax collected at the pump, flowing straight into the inflation number the Fed answers to. 3. Gold is holding above $4,400, record territory, bid higher as the Iran standoff worsens. Meanwhile, the VX, the market's fear gauge, is asleep at 15.5, and stocks barely moved. The world's oldest safe haven is screaming while the options market shrugs. Institutions are hedging something big, or volatility traders are missing it. One of those two prices is wrong. The argument starts at 8:30, gold above 4,400, Brent at 84, and a VIX at 15 that believes none of it. That is the macro picture today. The AI build-out just found a new checkbook. and it belongs to Wall Street, 1. Nvidia just lined up over $500 billion. Not revenue. Financing. Agreements with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to mobilize outside capital for AI infrastructure, data centers, chips, and the power to run them. Nvidia is no longer just selling the shovels, it is arranging the mortgages on the gold mine. Private credit becomes AI's landlord, and every company renting compute pays the interest. 2. CoreWeave, the AI cloud, more than doubled revenue to $2.58 billion, up 113% in a year. It also lost $626 million in a single quarter, more than double last year's loss, and the culprit is interest on the debt funding its build-out. The stock still climbed about 8%. That is the AI economy in one income statement. Real demand, violent growth, all of it running on borrowed money. The lenders get paid first. 3. Supermicro missed the quarter and won the year. Revenue came in at $11.1 billion, short of estimates. Earnings crushed, $1.62 against 96 cents expected. Then the guide, $65 to $72 billion in sales next fiscal year against 52.5 expected. The stock jumped about 8.5% after hours. A forecast 30% above Wall Street is management betting the AI demand curve is still bending upward. 4. A Bitcoin miner just became an AI landlord. Riot Platforms signed a 20-year deal worth $9.1 billion to supply Anthropic with 191 megawatts of capacity at its Texas facility. The stock surged about 20% before the open. Mining rigs earn whatever Bitcoin pays. AI tenants sign 20-year leases. Miners are sitting on exactly what AI is starving for: grid connections and megawatts. Power is worth more than hash rate now. $500 billion in new financing, 2 guidance beats, and a Bitcoin miner renting itself out as a data center. The build-out is not slowing down. That is AI today. At 8:30 this morning, Eastern, the government releases one number, the July Consumer Price Index. That number decides whether the Federal Reserve raises interest rates next month into an economy that is already losing jobs. Here's the trap the Fed is in. Its 2 jobs point in opposite directions. Inflation has been reaccelerating because oil is up around 16% since war closed the Strait of Hormuz. But the labor market just rolled over. America lost 23,000 jobs in July. Cut rates, and you feed the inflation. Hike, and you deepen the job losses. This morning's print is the tiebreaker. How we got here in 4 beats. Late February, war closes the Strait of Hormuz, a fifth of the world's oil flow disrupted. Brent begins the climb that ends near $84 mid-July. The June inflation report surprises soft, 3.5%, and for a moment, markets believe the scare is fading. August 7th. The jobs report prints minus 23,000. Recession risk enters the picture, and hike odds fall. This week, Cleveland Fed President Beth Hammack says multiple hikes may be needed, and the market settles near 36% odds of a September hike. Today at 8:30, consensus expects around 3.3 to 3.4%, with core near 2.4. In line, and the odds hold. Hot, and they climb toward a coin flip. Cold, and the hike scare fades into the low 30s. Now the part that matters for your money. Who decides? 12 people on the Federal Open Market Committee, weighing an inflation source they cannot touch. No interest rate reopens a strait. Who pays? If they hike, mortgages, credit cards, corporate refinancing, and a labor market already bleeding all get squeezed. If they hold, everyone holding dollars pays quietly through prices that compound, and the uncomfortable structure underneath. The inputs driving this decision are being set in Tehran and in a negotiation room in Washington, not in the spreadsheets the Fed points to. One more thing, this is not a one-day story. Producer prices print Thursday. Retail sales print Friday. Whatever 8:30 says today, the argument reloads twice more this week. The Fed calls itself data dependent. This week, the data depends on a strait. So here's the question I keep coming back to. If the Fed raises rates into a shrinking job market, To fight inflation caused by a closed strait it cannot reopen. Who is it actually protecting? Your paycheck or the dollar's credibility? Tell me in the comments, not the slogan version, what you actually think. This one is hard and I read every thread. Blue pill. The system is absorbing every shock. Earnings are strong. The ETFs swallowed a $130 million hack without blinking. And if the print comes in soft, the hike scare dies by lunch. Red pill. Jobs are shrinking, inflation is climbing, and the deciding variable is a waterway no central banker can reopen. Monetary policy is downstream of geopolitics now. Either way, that 36% from the top of this video moves at 8:30, and your money moves with it. The timeline keeps moving. We will see you in the next one.